Hi there everyone, a very good evening and welcome to the Money Show, the Nivesh special on ET Now with me, Avandabash. And yes, as you saw, the biggest investor education initiative, Nivesh, has clocked in more than 1 million pledges in the last 5 months. The Association of Mutual Funds in India as well as Times Network have come together to launch this initiative, one of the largest. And over the last 5 months, we've traversed the country, pit stopped at over 50 towns and cities, from Jammu in the north to Thiruvananthapuram in the south, from Rajkot in the west to Shillong in the east. We've met students, businessmen, professionals, wives of Indian Army personnel, factory workers, laborers, and of course educated them about mutual funds and spoken to them about the benefits of investing regularly in mutual funds and in a disciplined manner. We've urged people to join the Nivesh movement by pledging to invest at least 1 day's income per month into mutual funds. The momentum of this movement has been a staggering 10 lakh people in pledging to invest regularly into mutual funds in less than 5 months, and we want to thank you, the viewer, for being a part of this movement with us at ET Now. And those of you who have not yet pledged your 1 day income into mutual funds, here's your chance to become a part of the initiative. All you have to do is pick up the phone and give a missed call to the number 1-800-833-666. Before we proceed, let's hear it from NS Venkatesh, Chief Executive, Association of Mutual Funds, who talks about how we've helped the Nivesh movement bag such success and how one can look at the markets for the long haul to gain higher returns.
It's indeed a wonderful day for us, in the sense that over 1 million people have pledged to invest 1 day of their salary per month into the mutual fund sort of thing, which is new investors coming in. So to that much extent, the investor education efforts that AMFI along with the Times Network has put in through the Nivesh program is showing a good amount of traction. And I should thank Times Network for assisting AMFI in launching this Nivesh program. And I'm quite confident that this program will succeed, and we should see more and more new investors taking the pledge. Having said that, I would say that the new investors, the number of folios, the new investor folios are really growing at somewhere around 19-20% per month over the last 6 months. So that is a healthy sign that we are seeing. And the markets may be volatile, and that is the very nature of a market. And I would always say that the investors should be very, very disciplined, and they should continue to invest in a disciplined manner. Towards that, the systematic investment plan, or SIP as we call it, is very, very well received by the investors, and we are seeing upward traction in SIPs numbers. Over the last 6 months, the SIP numbers are showing an upward trend only. Despite the market being volatile, we are seeing an upward trend in SIPs. So that's a good sign. That actually indicates that the investors are getting matured and more disciplined when they are investing into the equity markets through the mutual fund vehicle.
All right, that's the view coming in from NS Venkatesh. Well, let's move on. And this show, remember, is dedicated to you, the viewer. So if you have any mutual fund related questions, please feel free to dial in. There's a number that will be flashing on your screens. And of course, we will be taking on board all of the email questions that we have on the Money Show at etnow.tv. Well, let's get straight to it. Jayant Pai, CFP and Head Marketing at PPFAS, is now with us to guide us over the rest of the show. Thank you so much for taking time out to join in. We have so much to discuss in terms of answering questions, but let's start off with, the basics of investing and how one can look at that in a very simple manner and investing in the right mutual funds. What's the take?
Yeah, so everyone is always keen on, which scheme to buy and what to do and which stock to buy. But the whole thing is that before you do that, take a step back and just follow the simple approach. So simplicity is the first step. Once you understand that, then everything falls in place. Don't get taken up by complexity. Don't get taken up by advisors who say that they can decipher complex products for you. A simple thing like, say, an index fund or a multi-cap fund which can invest in all types of companies, or say a term insurance plan. These are what you should actually build your foundation with. Then you can have some icing on the cake, but this is the first step. And if you cannot do it yourself, opt for a good financial advisor.
All right. Simplicity is the key, and it enhances the advisor's value in the investor's eye. Okay, we've got loads of questions and queries, and do remember our phone lines as well are open. That number should just come up for you, and you can send us any questions that you have. But for now, let's get in our email query from Shivan. She says, how can I start investing in mutual funds, and will the merger of mutual fund schemes bring down the investment cost? So what's the advice for a first-time investor?
Yeah, the best part about mutual funds is that you got to undertake, the procedures only once. So this is known as a KYC, a know your client procedure. It's very simple. So you first choose the scheme that you want, and then you follow this KYC procedure along with that. So either advisor or any person from the fund will assist you with this. Once this is done, then that same KYC is valid for all schemes throughout India. Your second question about whether it will bring down the cost or not, I feel that's more of a collateral benefit. The main aim behind mergers is to reduce the confusion. So there is such a profusion of schemes that people are confused, so SEBI just wanted to reduce that. Sure, once that happens, an individual scheme size will grow, and with that the chances of the expense ratio coming down is high, but that's a collateral benefit.
Okay, that's the take coming in with respect to investing in the right mutual fund schemes. Let's move on then to our next question from Sumit Manna. He says, I have SIPs in the following mutual funds and I intend to continue for another 13 years. Please let me know if I can amass a sum of 2 crore rupees with my current portfolio. So let's take a look as to the funds that he has in his portfolio. As of now, he's got the SBI Blue Chip Direct, 6,000. He's got L&T Mid Cap Direct, Mirae Emerging, Canara Robeco Emerging Fund, L&T Small Cap Direct, as well as Motilal Oswal Focused 35 Direct. Well, let's understand what exactly you're making of the kind of funds that he has in his portfolio. Do you think that he will be able to achieve the goals that he has, or has he sort of put his fingers into too many pies, which means invested into too many similar schemes?
No, overall I would not like to comment on these schemes in particular. But given his long time horizon, I have done some simple math. So he has to invest 47,000, he plans to invest 47,000 rupees a month. So if he earns around 13.5% a year, he should achieve this. So that's not outlandish, so it's possible. But more difficult is the psychological aspect. Because when you say 13 years, there will be dozens of ups and downs in the middle, and all throughout people will be telling you many things, and you may be tempted to discontinue this. So what I suggest is just close your ears and just keep doing what you're doing, and I feel you will achieve your target. If you are in doubt, you could ask your advisor.
All right, that's the take coming in on all of the schemes in your portfolio, and of course taking the advice of a financial advisor, that would of course be more prudent, but continue to remain a disciplined and a regular investor. I think that is something that he was also stressing upon. On that note, let's take a quick break, and as we do, let's hear out Dhirendra Kumar, CEO of Value Research, who recommends investors to stay put in index funds for higher returns tomorrow. He believes that large cap funds will undergo a churn for some time.
Large cap funds have lost the ground. They are no longer relevant. If you have to invest in a large cap fund, consider the ETF, consider the index fund, because they are everything else being uncertain about markets and returns from equity fund. One thing is definite, the expense, and you are guaranteed to get lower expense with the index fund. Individual investors don't have the index vehicles available for them for investing in the small cap fund. We don't have the small cap index fund, or we don't have the mid cap index fund, or we don't have the balanced fund index fund, balanced index fund, any kind of allocation available. So when I compare that, I think the opportunity in the Indian market for investors is in the sub large cap category, and I think mutual funds are adding value. I think the recent reduction on expenses might make them little interesting or impressive over a period of time. Maybe next 2, 3 years, 4 years, these funds might look, the actively managed fund might look better, because they have been forced, large caps will be forced to reduce their expenses, and they will look competitive, or it will definitely stack up in the performance number. But as of now, they look ugly, large cap funds.
Welcome back. This is the Jan Nivesh special right here on ET Now. We're celebrating hitting that 1 million mark of pledges for our investor education initiative. And we would like to thank all of our viewers, and we urge you to take the pledge. Remember, we're in conversation today with Jayant Pai, CFP at PPFAS, right here in our studios. Do you have any questions or queries regarding pruning your portfolio? Which are the right mutual funds to invest in? If right now is a good time to put your money in, which are the funds that are right for you? Well, do remember, there's a phone number that's flashing at the top of your screens. You can just pick up the phone and dial in, or simply email us on themoneyshow@etnow.tv. Well, let's take on board Nagesh's question, and this is from our Jan Nivesh On Ground initiative in J&K. Says, I'm 33 and I have started 3 SIPs of 5,000 rupees each. This was about 6 months ago. I hold the Aditya Birla Sun Life Infrastructure Fund, Aditya Birla Sun Life Small and Mid Cap Fund Growth, ABSL Balance 95, Growth Regular Plan. He says, I want to earn 2 crores in the next 15 years and have the capacity to steadily raise my SIPs by around 10% per annum. Should I shift from a regular to a direct plan given the time horizon I have, wherein the differential expense ratio upon compounding can make a difference in the corpus upon maturity? Can you please advise? Okay, so he's just started about 3 months ago. He's 33 years old. Let's address the question as to whether or not he has put his funds, he has diversified adequately. Do you think a sum of 2 crores over the next 15 years, he can make that? And of course, address his question with respect to direct and regular.
Yeah, so again, as an extension to the previous question, I think just doing the math, it looks quite achievable, because you got to earn around 15% per annum. I'm not saying it's very easy, but it is doable. What adds to the possibility of it being achieved is that you plan to increase your SIP by 10% every year, which is very commendable. You know, most people get stuck with or fixated with one figure and they don't really increase it even though their incomes go up. So that's a very good thing. Prima facie, it looks like you are on the right track. Second is with regard to diversification. I mean, it's not that it's, you know, more the merrier. So 3 schemes are enough, provided they give you actual diversification. So say a mix of a large cap, a mid cap, and say a small cap fund is really good enough, rather than having 10 schemes of the same category. So that's one thing. Second is your query on regular and direct. Rationally, yes, if you make the move, it does help you save cost, and that compounds. But the second point is, do you have the ability to choose good schemes? So if you can do that, if you can hone in on good schemes and also have the, you know, sometimes you require psychological support of an advisor when things are not going your way. So if you are able to, overcome your own emotional sort of hurdles, then yes, direct is okay. But otherwise, go in for a regular with a qualified financial advisor.
All right, that's the take coming in. I hope we were able to answer your question. But you know, you did stress upon just continuing to remain invest, not getting perturbed by market fluctuations. But the fact of the matter is that we've seen a lot of volatility in the markets. We've seen mutual, FII flows as well. They've been on tenterhooks. The macros weren't working in our favor. Now, yes, crude has stabilized. The currency has come under control. But in terms of timing the market, that also seems to be a little bit difficult. And at a time when the markets look volatile, investors tend to steer clear. So for those who are watching, what's really the advice when there is bouts of volatility, which I assume are going to happen yet again come the elections, etc.? What exactly would you like to tell investors?
No, so most of the people who have raised queries are already, they have begun SIPs. So I think that is the best way to go ahead. So I really don't have any elixir to offer you. So it's, you just keep doing the same thing, just continue your SIPs. Sure, you just, listen to the news for entertainment, but don't get perturbed, because there are 10 things outside our control. The only thing in our control is to do these SIPs and to just keep at it, and perhaps rely on a, on a strong financial advisor if at all you do require it.
All right, don't get perturbed by the volatility in the markets. Be disciplined and keep your investments going. Remember, if you have any questions or queries, we'd be happy to take it up. There's a number that's flashing at the top of your screens. You can dial in. Well, Sandeep Singh sends us a question. He says, I'm 40 years old and I have invested in the following funds. Can you please review my portfolio? Let me know if I need to make any changes. The goals are my children's higher education, marriage and my retirement. He's got the Mirai Asset Opportunities Fund, MOSL Most Focused Multi-Cap, HDFC Balanced, Franklin India Prima Plus. He's holding the Aditya Birla Sun Life as well as ICICI Pru Value Discovery. So he's fairly specific in terms of his goals for his children's higher education, etc. What do you make of, his fund selection in terms of, do you think he should perhaps prune his portfolio down a little bit? And what would you advise him to do with these goals that he has in mind?
No, again, I mean, prima facie, his portfolio looks okay because they do have some diversification within them. But maybe a scheme or two could be pruned. But those are tactical things which, only your advisor who knows your entire case history could advise you. Otherwise, I'm happy that you have begun this and you have your goals very clearly in mind, because often people don't really know why they're investing. Here you are very clear. What I suggest is that you divide each goal and invest specifically for that. So once you create a bucket for each goal, then you don't tend to get waylaid. So you don't also tend to get tempted to withdraw and to time the market and all that, because you know that your goal is way into the future. So that is something which I follow. Divide your goals into buckets and invest specifically for that goal and have a specific portfolio for each one.
But you were also talking about, portfolio not having schemes which have very similar portfolio characteristics. Can you elaborate a little bit more about that in terms of how one should go about the selection? You think that ideally in a regular portfolio like a large cap, mid, multi-cap, that is more effective? Can you just give us a little more perspective?
Yeah, that is provided the schemes are really different from each other, because there should be some truth in labeling. So I mean, this is jargon, but basically whatever the scheme professes to be, it should actually be able to do that. So one way to get around this is to just choose a couple of multi-cap schemes. So these schemes don't have any constraints in terms of large, mid and small. Wherever the opportunities are there, they go. And some even combine this with investing abroad. So on one hand, I am saying that simplicity is good, and some of these schemes look complex at the outset. But what they do is they actually enable you to take part in a lot of different situations without you being, fully involved in it. So you can continue with your life while these fund managers keep doing what they are good at.
All right, that's the take coming in with respect to even portfolio or fund selection in your portfolio. Let's get in our next question from Milind. He says, I want to start an SIP of 3,000 rupees a month for my newborn for his education and marriage. Since it's a long-term view, can you advise some steady mutual funds? So what would you tell him? He's willing to put away 3,000 rupees. Would that be sufficient in SIPs? What would be the take?
Prima facie, I don't think it is sufficient, because you have more than one goal. So I think I mentioned two goals.
Yeah.
So 3,000 is a very low figure, but I'm happy you're considering it. So this is a good place to start. And also I think don't overcomplicate things by having more than one scheme. So currently with this 3,000 per month, one good scheme is enough, perhaps one multi-cap scheme. Of course, as your income grows, I really suggest you increase your SIPs. And so overall 15 to 20% of your income should go into SIPs and equity mutual funds in case your goals are 5 to 7 years or beyond. So that's a thumb rule. Beyond that, your financial advisor could give you a further granular take on this.
All right, perhaps a little more money being invested every month would help you out. Do remember, we have our email ID, that's themoneyshow@etnow.tv, where you can send in your questions. On that note, Jan, thank you for joining in today on the show. And as we wrap it up, congratulating ET for the resounding success in spreading the Jan Nivesh movement. Sandeep Sikka, ED and CEO at Reliance Nippon Life, says initiatives like this help in penetrating the knowledge of financial products in the country. Let's listen in. Thank you for watching.
No, you're right. I think if you look at the mutual fund, the industry has been growing. And if you look at the theme of the conference also today has been distribution. It's not only about mutual funds, but it's across all products, insurance, banking, life insurance, general insurance. I think one thing clearly comes out, across all industries, if you were to see the penetration of financial products in India is very low. And if you have to reach out to these investors, I think distribution is going to hold the key. So I think there is no debate. I think it's a foregone conclusion. I think the any industry cannot grow till the time we have a well-oiled distribution machinery. So today also in the conference, I think what came out clearly is distribution is going to be must. How do we ensure, the entire distribution is done in a manner which takes care of the interest of the customer also, as well as helps in the growth of the industry.
Jan Nivesh crossing the 1 million mark, how do you see the road ahead?
No, it's an outstanding initiative. I think the way I take it is it's a great initiative done by ET Now. I think it's touching the life of so many Indians, and typically in a country like India, where 2% of the household saving is coming into financial products. There could not be a better initiative than this. I wish ET Now all the success and many more like this.
Lastly, if I could ask you, how do you see FY19? Because clearly markets have been volatile, but as you rightly said, SIP as a product continuing its journey. How do you see FY19? And clearly mutual fund industry is coming of age and clearly playing that role of countering the FPIs, although a long way to go, the process has begun.
No, clearly I think I will not be able to predict what happens in 1 year. But clearly our outlook on India has been positive. We believe, I think everything that is happening, clearly we are already seeing green shoots. The Q2 numbers have been good. Oil is also supporting. And I think next year is the era of elections. So I think very difficult to mention what happens in 1 year. But from a long-term point of view, we believe Indian structural story remains intact. I think we'll clearly see India growing at 7-8%. And I think it's our role as asset managers to keep generating that wealth for investors. On your question of mutual fund industry, clearly I believe what has happened is just mutual fund industry has come a long way, but still it's a bigger journey that we have to go ahead. At this point of time, if you look at it, only 3% of the Indian population is investing in mutual funds. I think the way I clearly see it's the day is not far away when SIP will be part of every Indian's monthly wallet. So I think that's how bullish I am on SIPs.